So I'd like to welcome you to Affiance Financial's 2020 market forecast. The voices you're hearing today are Seth Meisler and
Marc Usem.
And together we are part of the investment committee for Affiance Financial. So we're really happy to give you this update of what we're seeing in 2020. We do need to give this important disclosure information, which will take about a minute or so. Please remember there can be no assurance that the content made reference to directly or indirectly in this 2020 market forecast will be profitable or suitable for your individual situation or prove successful. Due to various factors, including changing conditions and or applicable laws, the content is only reflective of current opinions or positions and is subject to change at any time and without notice. Moreover, you should not assume that any discussion or information contained in the 2020 market forecast serves as the receipt of or as a substitute for personalized investment advice from Affiance Financial. Please remember to contact Affiance Financial if there are any changes in your personal financial situation or investment objectives. A copy of Affiance Financial's current written disclosure brochure discussing our services and fees continues to remain available upon our request. In other words, these opinions are our own, and you should talk to your financial advisor for any specific recommendations. So what are we going to talk about today? We're going to take a quick look back at 2019 and discuss what happened in 2019 and certainly how some of that does influence 2020. We're going to explain to you today why we are cautiously optimistic and talk about specifically what actions the Federal Reserve has done and how that is impacting our market forecast and things that you can do now. In our live session, we did have a Q&A that obviously will not be in the recording. So whenever we do forecasting, there is a degree of humility that is needed since no one can predict what is going to happen in the future. 6 weeks ago, certainly, as an example of this recording, the coronavirus was not on the radar. And so different events can certainly change, geopolitical events can change what happens in the marketplace, although we still feel like our basic forecast is intact going into 2020. So who better to talk about the future than a science fiction author? And N.K. Jemisin writes, "It's the way the human brain works. When enough events occur in a pattern, we stop thinking and go into macro mode." And I thought that this quote was appropriate because you're going to see a lot of macroeconomic indicators and how that is influencing our thoughts about the stock market and the economy today.
The other quote on the slide is, "There are no facts about the future, just opinions." So we love Howard Marks, who's a fairly famous manager of bookmark funds, and that it's true. We certainly will give you our opinions about the future, and they are just that. So 2019 was a great year to be an investor. Nearly every asset class was up considerably. The U.S. was up more than international in general, and combined stocks and bonds had the best combined year return since 2009. So terrific year. Let's just walk through some of the numbers on the screen. I think a bit of a surprise was crude oil, top performing asset class, up over 34% last year. U.S. stocks close behind at 31.5. Real estate did exceptionally well. Small caps, again, all were up, but a little less. And then you see Europe, Australia, and the Far East, sometimes called the EFA index, up 22. So even though Europe lagged, it was still a very strong year overseas as well. The emerging markets were up 18, lagged again a little bit behind Europe. And then I think, again, a surprise is commodities and gold, often thought of as a more defensive or hedge type of investment, were up considerably as well, up 17%. And the other big surprise was bonds. Bonds up 14.5% for corporate bonds, and the U.S.A. up 8.7%. So across the board, a really incredible year for all asset classes.
If we look at 2019, how does 2019 stack up versus other years? We'd say pretty good. It's in the top 20% of historical performance. Certainly not a top 10% or one of the best years ever, but a very strong showing. So that is really good. We're happy about that. And but certainly years can be better. and we've seen years be worse. So it's in the range of, we would say, a normal market performance, even though it was certainly a phenomenal year. What's more important is looking at 2019 in a larger context, specifically with 2018. And that is that looking at the combined 2 years together, the return for those 2 years is 25.7%. So certainly a better year than historically average, but a much more normalized year. And why is that? Because at the fourth quarter of last year, in 2018, we had a 20% drop in the market. So a big drop in the market in the end of 2018. And that first quarter of 2019 was a big recovery, a very quick recovery off that steep market drop. So a portion of that 2019 return is a function of the 2018 drop. And we need to take that return, that 2019 return, in context. Looking at the 2019 return by quarter, you can see where the return, that 31.5%, really came from primarily 2 quarters. The first quarter of 2019, which was, again, that recovery from that steep drop, as well as the fourth quarter of 2019. And in the fourth quarter of 2019 is where we had the phase 1 settlement agreement with China in terms of trade. So there's also some lag effect with Federal Reserve actions in 2019 that we think affected 2019 performance as well. So what's really interesting is that in 2018, individuals were big sellers, net sellers of the stock market, as well as mutual funds, pension funds, life insurance companies. We'll talk about that later. And if that's the case, if they were sellers in the market in 2018, chances are that those people who sold out did not participate in a good chunk of the 2019 performance. So sellers in 2018 probably didn't participate in maybe half of 2019 performance, which leads to really an old adage that it's time in the market, not market timing, that really generates performance.
One of the big contributors to the 2019 increase in asset prices, we think, was the Fed's U-turn. So at the end of 2019, the Fed came out, made a statement, and said, central bank lifts interest rates, lowers forecast to 2 hikes in 2019. So prior to that, the Fed had been raising rates every quarter during 2018, and the expectation was that was going to continue with 3 more hikes in 2019. So this was the first time that they actually broadcast to the market that, hey, we may not be going as far as expected before, and there may be some changes in Fed policy based on what's happening in the economy. That was sort of the catalyst that helped, I think, turn things around in 2019. We'll go into more about that later.
So the good news is we talked about 2019 and what we saw in 2019. So what is 2020 like? And the good news is that our base case is that we're cautiously optimistic. We think that both the economy and the stock market return look poised for a good return for 2020. The bad news is the stock valuations are high. They may be priced in for perfection, and thus the risk of a market correction is higher than historical. Now, that doesn't mean that we think that there will be a market correction, in other words, a big 20% drop in the market. We think that that is not probable in 2020. However, that risk of that happening is greater than historically speaking.
So why do we think that economic growth is likely to continue? Let's look at some of the economic indicators that lead us to that conclusion. So first is leading economic indicators are positive. So we call them leading economic indicators, or LEI for short. They are a combination of a bunch of different elements that tend to give us some indication of where economy is headed. It contains things like average hours, unemployment claims, manufacturing new orders, building permits, stock prices, and so on, all combined into this one indicator that gives us some forecasting. And you can see that over time, at least since the Great Recession and the rebound, it's been pretty constant between that 1% and 2% range, and certainly hasn't rolled over like it had before prior recession. So you can see it's pretty consistent In the prior 3 recessions, leading economic indicators have rolled over considerably. We're just not seeing anything like that at this point.
So do we think a recession is going to happen in 2020? Our opinion is not likely. We have seen manufacturing drop off in the US as well as in Europe and China, which is concerning and something that we're watching. But on the positive side, we have seen strong consumer spending growth. And that's been a real push forward for the economy. You can see that the US retail sales growth, this is as of the end of October, was 4.1%, greater in China, a little bit less in Europe, but still positive and growing year over year. So why is that? So first, we're going to take a look at the personal consumption expenditures. That's the blue line and the left-hand axis. And you can see that personal consumption expenditures have been pretty solid since 2010, roughly between that 2.5% to 5% range. And so again, no real change there. That for us is a positive sign. But there's another part of the story that's positive as well, and that's what are consumers spending their money on? And that's the right graph, the right line and the right axis. And what you can see is that prior to 2009, over 13% of personal expenditures went towards debt service. So this would be something that a consumer had purchased on loan and now was paying that back. That's dropped considerably since 2009 to where it's less than 10%, from over 13% to 10% of consumer expenditures is going towards debt service, which means that they're able to spend money on additional consumption, which is positive for the economy. So really, overall, we think that the consumer is in pretty good shape.
Pretty amazing, lowest it's been in 40 years.
Yeah, good job, consumers.
So another viewpoint of consumers' strength is employment and wages. And the unemployment rate has dropped considerably since the Great Recession, from over 10% to 3.5%, which is pretty much tied with a record low today, meaning people that want to work are working. In fact, participation rate, meaning the number of people that can work that are working, is also at a record low. And that's been one of the things that's helped to allow this to continue to the low levels that it's at now. At the same time, we've started to see some wage growth. And that's a good thing. It was very low after the Great Recession and continued to fall until 2012-13, and then has moved up a little bit. And you can see that cycle has repeated itself through time. But we don't see the kind of excesses in wage growth that we did before. In fact, it hasn't even broken the 4% level yet. It's at 2.9%. So we haven't seen, again, something that would lead us to believe there may be trouble in the labor markets right now. And this says the consumers are working, they have money in their pockets, they're able to spend. And in fact, that wage growth is growing a little bit, which is good. So housing starts is another indicator we look at to get a sense of what's going on in the consumer market. We tend to see consumers buy things as they buy new homes. They'll fill them up with new household goods, furniture, and maybe cars and things like that. So it tends to sort of foreshadow what's going on in consumer spending. And at this point, new housing starts are up considerably. One of the reasons is that interest rates have continued to drop and then drop again in 2019. And that's part of the reason we've seen this spike, is because affordability has gone up. So this is another good indicator for one of the reasons why we expect this to continue. Moving on to inflation, a little bit different kind of indicator, meaning how are prices in the economy moving? Now, the more volatile line is Consumer Price Index, or CPI. And the red line in the middle is what we call core CPI. That's removing the more volatile food and energy components that are part of the total CPI. And one of the things that I think is pretty amazing about this chart is that since the late 90s, at least, it's been incredibly stable. At least the core CPI has been incredibly stable. And it's around 2%. The Fed target, by the way, for inflation is about 2%. They've actually said they'd let it go a little bit higher. They have a greater fear, if you will, of deflation than inflation at this point, but nonetheless, It's been very stable around the 2% level. We did see some more volatility in the overall CPI, and you can see the oil market crash back in 2015 when oil prices dropped considerably. So one of the reasons that the volatility in that other series is so high. Nonetheless, very stable inflation, and that's a good sign, and one of the reasons that we don't expect the Fed to do anything outlandish anytime soon, meaning raise rates.
The next slide is, I would say, a good news, bad news slide, in that one of the components of economic growth or growth in the United States is government spending, and we can see that government spending growth. And so that would be another contributor to what we call gross domestic product growth, the GDP, and general economic growth. However, the bad news is that that increase in government spending also increases our debt level. And that becomes a problem as well. And we'll talk about that in more detail. So a little bit of a good news, bad news, but certainly in the short run, positive, stimulative for economic growth. And what you can see here is that GDP growth is pretty stable. Again, we think it's positive. We think it's good, growing is good. Obviously, if GDP, you can see in the recessions, the three last recessions, that GDP drops off pretty significantly. There would be a decline in GDP, and we're simply not seeing that. 2% is less than what has been historical prior to the 2007 through 2009 Great Recession. Historical GDP growth was closer to 3%. So we are seeing the rate of growth has been a lot less in the last 10 years, but it's still positive, which leads, again, another indicator of why we're positive on the economy and in turn positive on the stock market. The other interesting thing is that GDP growth has been solid throughout the United States. This map represents all the different states, and the numbers are the GDP growth at the state level. And what you can see is that all of them are positive. Interestingly enough, Texas is 4%, it's a higher growth. We think that's probably because of oil, which we talked about earlier, that had such a high increase in price, would lead to Texas having higher GDP growth. But again, all the states are positive. We think that is really a sign of general health in the economy.
So 2019, let's switch gears a little bit. 2019, great year. How did it work? Did the Fed just perform a great balancing act? And we got this slide that we think that's Jay Powell sitting out there balancing across the building. So the Fed's U-turn is our focus again. We talked about this earlier, but we think this is a key component for what's happening in the stock market right now. And the Fed not only turned and said, we're not going to continue to raise rates in 2019, they actually switched gears completely in 2019. And as it says on the slide, they acknowledged the slowdown in economic growth. The stock markets plunged in late 2018, and the strong dollar making exports more expensive for overseas customers. They also acknowledged the trade wars going on, and there were more headwinds than perhaps they had thought earlier on. The stock market drop, I think, was a big piece of their decision-making process, a 20% drop, which, again, most people maybe not have noticed if you didn't look at your statement for a few months because it snapped back so quickly. Nonetheless, it was a big drop, and the Fed knew that there was something they had to do to step in, given all the headwinds. So not only did they not hike, they actually turned around and cut rates 3 times during the year with the knowledge and expectation that things were actually weaker globally than they had imagined before. And that was a big piece of what helped drive stock and bond markets in 2019.
What you can see is that it's not only a U.S. Federal Reserve phenomenon, it's really a global phenomenon. And on this chart here, all the countries that have dark blue are ones where the most recent central bank action has been to decrease interest rates. The light blue would be where they have increased interest rates. And what you can see is the vast majority of countries have been decreasing interest rates. Again, stimulative to try and grow the economy, grow their respective economies. But what we would also suggest is it really shows how tied in all the countries are today, that it's much more of a global economy, a global phenomenon.
In the lower left corner of the slide, you can see the 10-year bond yields. And one of the things I think to highlight here is that the US has about the highest yielding bonds in the world, and they're not very high yielding, right? About 1.7 on the slide, but 1.6% probably today. With Europe, mostly the German and French bonds with negative yields, and Japan at negative yields as well. This has been an anomaly of sorts that's been going on for quite a period of time. And it just shows to some extent that the US is in a better place to have more room to lower rates if needed than some of the other countries.
There's another part of the story as well that we think is really important. When we talk about Federal Reserve actions, the most obvious one to most people is the rate cuts because it affects lending rates, mortgages, bank deposits, etc. But there's another thing the Federal Reserve is doing that we think deserves equal exposure, and that has to do with what's on its balance sheet. And so we have to really go back to 2009 and look at the Great Recession. And one of the concerns that the Federal Reserve had was a lack of liquidity in the markets. And so how did they try and bring money into the economic system? They did that by buying bonds on the open market. And they bought bonds from they had on their balance sheet back in 2009, about $1 trillion in bonds. And they continued to buy bonds going up to $4 trillion. So a very significant increase in their balance sheet. Now notice it didn't happen all at once. They tried to increase their balance sheet in a stepwise fashion, multiple times trying to stop their bond purchasing programs only to see the economy and the stock market falter, and then to restart that process again. Back in 2018, they decided to decrease their balance sheet exposure, and so really brought that balance sheet exposure below $4 trillion. As they were doing so, the economy and stock market started to falter, such that going into 2019, not only did the Federal Reserve decrease interest rates, but they also added more to their balance sheet. And we would suggest that adding to the balance sheet is part of what stimulated the stock market growth in 2019.
So the Fed has done a few things to help drive markets here. They've lowered interest rates and they have increased their balance sheet. And I think this quote was very, very interesting to see in late last year, where Fed Reserve Chairman Jay Powell came out and said, I think we would need to see a really significant move up in inflation that's persistent before we would even consider raising rates to address inflation concerns. We talked about inflation earlier, but this is just another reason that we think the Fed isn't going to change their stance on lowering rates anytime soon.
Yeah, in fact, the market right now is suggesting that interest rates could drop one more time in 2020, although the Federal Reserve has been pretty reluctant to suggest that interest rates would drop in the future, and has been trying to suggest that they would like to keep interest rates steady, staying pat. So certainly we don't see interest rates going up. I say the question mark is, would it drop again another 25 basis points or not?
So this is a quote that we like that came up recently from Janet Yellen, that bull markets don't die of old age, they get murdered by the Fed. What does that mean? So we have a lot of questions of how long can this last? How long can the markets continue to go up? How long can the economic expansion last? And it's really, there's no limit, right? It can go on for a long time. Nothing that says that it has to end at a particular time. We do still believe there's a business cycle. We do still believe that there are ebbs and flows. However, we don't have to have a recession at any given point. Historically, we've had recessions when there's been an excess of some sort, a bubble in part of the economy, and the Fed has stepped in and raised rates and created the situation that brings on a recession. So this is a slide of Australian annual GDP growth rate from 1995. Why are we showing Australia? Because since 1995, Australia hasn't had a recession. So it's had 46, 47 years of expansion, and they have not suffered a recession during that entire time. It's just a symbol, if you will, that there doesn't have to be a recession at any certain point in time. Now, given The Australian economy is much smaller than the United States and much less diverse, about 1.5 trillion versus our almost 20 trillion. So not maybe apples and apples. Nonetheless, it's sort of a lesson that we don't know how long the cycle will necessarily last. I had one other just comment I wanted to mention, which is why are we talking about this so much? Why are we talking about GDP and why does it matter? And I think it's just important to sort of say economists have forecast 10 of the last 3 recessions. So we're not great at forecasting recessions, but we care about it because when we're not in a recession, stock markets can go up and down, tend to go up, but we know that during recessions, they do tend to go down. So that's why we kind of want to say or try to forecast when we think the probability of that is higher.
I would agree with that. And it's really important for investors to remember that the economy is not the stock market, and the stock market is not the economy. While we talk about them being related, think of them as cousins, that they're related. Their relationship is interest rates that can influence stock and bond prices. Certainly, stock market can go up and down with a healthy economy, and even as the economy is dropping, the stock market could be going up or down. The stock market will move ahead of the economy many times, both on the ups and on the downs. So, changing perspective a little bit, we do want to focus on the stock market. And one of the interesting things is who's buying stocks and who's selling stocks. And so looking back at 2018, the big sellers of stocks in 2018 were mutual funds, pension funds, households, life insurance. The big buyers in 2018 were corporations purchasing back their own stock, as well as foreign investors. What's really interesting is that corporation stock buybacks were greater than the net sales from life insurance companies, households, mutual funds, and pension funds combined. So a really big number. Why we think that's interesting is because that drop in 2018 and subsequent recovery was one of the quickest recoveries in the last 50, 60 years of stock market history, with that big of a decline and that quick of a recovery. So that became very interesting. And one of the things that it leads us to believe is that with the corporations repurchasing their own stock, it's hard to see a consistent or long period of time where the stock market would be falling because of that buying pressure by companies. The other good news, again, looking at the stock market, is earnings. So a big driver of stock market returns over the long run is corporate earnings. And 2019 was not a great year for corporate earnings, frankly. The year-over-year growth in corporate earnings was roughly 1.4%. But 2020 looks pretty good. Currently, the expected earnings growth year-over-year is at 9.2%. Now, we know that everyone is always over-optimistic in terms of earnings growth year-over-year, and that always gets whittled down. But even if that drops in half, let's say, to 5% year-over-year earnings growth, is still positive, and we would say is a good thing for the stock market. So again, while growth could be more subdued, it certainly looks pretty good.
So let's zero in on earnings a little bit more. This is a chart of the S&P 500 price, which is the blue line on top, and S&P 500 earnings per share, which is the red line underneath. And you can see they follow each other very closely, at least in shape. The scales are different, of course, but nonetheless, they follow each other, which we'd expect because earnings are the ultimate underpinning for stock prices over time. So one of the things that happens is there's something called a PE ratio. That is, the market trades at usually some multiple of earnings to get to the price level, and you can see through time that has changed. So back in 2000, the PE multiple was 18. In 2007, before the crash, the PE was 26 at the high. In the high of 2018, before the crash at the end of that year, the PE ratio had gotten up to 19. So we see some differences in PE ratios over time. And where we are today is about 18 times next year's earnings of $175 per share, which is expected now. So the top of the chart on the right side, sort of going straight up there, that is the expected earnings for next year. So we do expect earnings to grow significantly next year. like Seth said, maybe 10% or so. And that's one of the things that's helping to continue to drive stock prices higher.
Mark, one question I have. In an earlier slide, we talked about GDP growth being 2% in the last 10 years versus 3% prior to that. So the growth in GDP has been significantly lower, 2/3 that of historic growth. Yet when you look at corporate earnings, what you can see is that the growth rate of corporate earnings over the last 10 years has been greater than prior to that. So even though GDP has been growing slower, corporate earnings have been growing faster. What do you attribute to that?
Great question. I think a couple of things. One is really boils down to the global nature of the U.S. stock market, meaning the largest companies in the S&P 500 index are largely global multinational companies that are earning money outside of the U.S. as well as inside the U.S. And as those companies have grown, their percentage of sales and profits from outside the U.S. have grown as well. So in a way, we've sort of stolen growth from around the world and brought it back to the United States. I think that's one of the big drivers of the increase in earnings growth relative to GDP growth. I think if you took the whole world, though, and put the whole world's earnings together, it would probably be closer to the entire global GDP growth. But here we've been able to actually steal some from the rest of the world.
So we've given you the good news on the economy as well as on the stock market. Now it's time for the bad news. So what's our concern over the economy and the markets? What is it that would cause us to pause or rethink our theories about being what we call being cautiously optimistic? Well, valuations. So stocks are relatively expensive. And if we look at where the growth has come from, what you can see is, it's kind of interesting. In 2018, earnings growth was pretty good. And a lot of that was because of the tax cuts. But the expansion of stock, the multiple expansion or the price of the stocks went down. We know that was because of that steep drop in 2018. In 2019, it's the exact opposite. Earnings growth was pretty subdued. We showed that in an earlier slide. It was positive, but wasn't really all that great. What happened? The multiples growth, or the price of the stocks, went up significantly, much greater than the earnings growth. Going into 2020, it's pretty hard to see stocks continuing that multiple expansion, that expansion of prices, without something underpinning it, particularly earnings. If we were to look at earnings or price over earnings on a historical basis, when we talk about the PE ratio, just take a step back. What we're talking about is the total price of the stock market divided by its earnings per share. So over the last 25 years, the historical average of the PE ratio is 16.28 times. In other words, people would be willing to pay 16 times earnings for a stock of the market. And today we talked about over 18 times. If we were to get back to the historical average, you would be looking at about a 20% drop in price without any change in the earnings. However, we have to take this in context, because even though the average has been about 16 times, the actual PE ratio reported never hits that 16 times. It's either too high or too low, and even at 18 times, it's been that way for a number of years. And the PE ratio could get back to a more historically normal level not by a price drop, but by earnings growth. So there's an old saying that when your head's in the freezer, your feet's in the oven, your body must be at average temperature. And I think that's certainly the case here, that there are periods of time where the PE ratio is too high, the PE ratio is too low. So it's not necessarily a great indicator of anything happening in the near future with stock prices. But it is something to be aware of.
I think just to one comment there is, between the market crash in 2001, 2002, and 2007 highs, you can see the PE ratio actually declined over most of that entire period. What was happening during that period of time, though? Markets were going up, right? So it's very difficult to maybe have a conclusion from this other than that earnings and stock prices move somewhat in tandem, but not always the same direction. So earnings were actually growing faster than stock prices were during that period. And that could happen again, meaning earnings could continue to grow faster than stock prices going forward to help support an increasing market. So focusing back on risks, one of the risks is rate shock, or our ability to influence GDP growth with interest rates. And we talked about the United States being in the best position for that. This just shows it a little more graphically with other countries and where their rates are. You can see most of the rates in the rest of the world are very low, around 0 or less, meaning they have very little flexibility to use interest rates to influence GDP growth or for monetary policy purposes. And the United States remains in the best position to do that, although, again, we're at 1.75% Fed funds rate. We don't have a ton of room, but still better than the rest of the world. So having this tool, I guess if you'll call it, in your tool belt is great, but as you use up your bullets, it gets less and less effective. And so it's just one of the risks that are out there as well.
So is there anything else that could affect stock market prices? The answer is yes. Trade wars could certainly rear its head back up. Things could get unsettled or unwound, just as we saw things work out in the fourth quarter of 2019. Who knows how things are going to look for 2020? Currently, it seems positive, but you never know. Brexit happened at the end of January. What the outcome of that and how that affects global economy is not yet certain. I've heard there's going to be an election in 2020. And so the outcome of that election, even the process, leads to uncertainty. Markets do not like uncertainty. And so that would lead to, we expect that 2020 is going to be a more volatile year because of the uncertainty related to elections. And certainly the geopolitical, Hong Kong, Iran, coronavirus, etc. All of those geopolitical issues can lead to stock market uncertainty. In addition, we have a manufacturing challenge. Going back from 2018 through 2019, manufacturing did drop off considerably and in fact shrunk. That to us is concerning. We believe that a lot of that was due to trade wars and tariffs, that companies simply sat out to see what was going to happen. And so overall, we are positive that we're going to see a rebound in manufacturing, but it is something that we are concerned about and are watching. And again, earlier, just taking a deeper dive on trade, what's the impact of trade on the stock market? Well, you can see here that from November 2016 to 2017, end of 2017, that the world stock market was up 36%. But since tariffs were announced, and since we had this disruption to the global economy with tariffs and trade, the stock market has been only up in that period of time about 4%. So tariffs and trade and that level of uncertainty does have an impact on stock market prices. And what we can see now in this chart is that the general uncertainty by individuals is greater today than it has been in the last 10 years. So more people are concerned about geopolitical issues, more people are concerned about trade issues. And again, markets don't like uncertainty. That tends to not be good or create more volatility in prices, at least in the short run.
So let's focus on the election a little bit more. What does history teach us about presidential elections? Well, this is one chart that tries to explain. So the top line is years with no election. And in those years, returns are pretty good. The average close to the long-term average of around 10%. In years where there are presidential elections, returns tend to be a little bit lower. Not a ton, but a little bit lower. And strangely enough, the charts look very similar. But what happens after election years, generally in years without elections, the next year is about 5.8%, versus years where there are presidential elections tend to be better, actually. The year after the election tends to be better, up more than 10%. So, of course, averages are hard to necessarily extrapolate into the future. And this year is going to be a little bit different with having a president that's been impeached and for the first time will be up for re-election. So that will be interesting. We would say that the volatility and noise created by this is going to be high, and we recommend turning off televisions, iPhones, and other news sources to try to limit the amount of noise coming through, because I'm sure there's going to be a lot. We don't want that to affect investment decision making. We don't think that at the end of the day, the elections have a huge impact on the markets. We think the one place where we would be more concerned would be if the parties flipped. So if there were a Democratic president and that the Senate turned and actually became led by a Democratic majority, I think if the House remains split and we get a Democratic president, we'll probably see very little policy get through. So we'll be watching what happens carefully and cautiously optimistic that we believe things will continue in the manner that they have and move higher.
So long-term, our outlook is that, again, while we're cautiously optimistic this year, we've talked about some of the good and the bad. It's important to know that our expected returns over a longer period of time are likely to be lower than historical averages. So why is that?
So one of the reasons is that valuations remain relatively high using this gauge called the CAPE ratio, the cyclically adjusted PE ratio. Now, we talked about PE ratios before, which is the price of the stock or stock market relative to its earnings. In this case, earnings are averaged over a long period of time, about 10 years here, to smooth the ratio over time. And what we see here is that as CAPE ratios get high on the bottom part of the graph, the 10-year forward real stock return becomes lower. And not a huge surprise, but nonetheless, this is a very coarse kind of tool, meaning directionally it gives us some indication, but you can see in almost every case, the actual returns overshoot on the upside and the downside the forecasted returns. So it's a rough gauge, but nonetheless leads us to believe that returns over the next 10 years probably a little bit lower than the prior 10. This is where we are today, the CAPE ratio of about 31.7. You can see definitely in the higher range of history, and this goes back to 1900. This effect is global in nature. So this is another visual presentation of the CAPE ratio in different countries. And on the little box in the chart, it shows the correlation. That means how closely does the data fit what actually happens. And in the US, it's relatively low compared to the rest of the world at about 58%. Nonetheless, it gives us an idea that this curve exists. It looks the way it does. And so we're at about 31 times on the PE ratio, on the CAPE ratio now, which would imply a real return of about 5% or so over the next 10 years, versus if the CAPE ratio was, say, at 16 instead of 30 or 32 or so, we'd see about a 10% real return. Now, when you think about real returns, we would add inflation to that, meaning that probably around 2% kind of number is where we think inflation probably is, and it has been. We've seen that slide. So a 5% real return would translate into about a 7% nominal return. So again, rough tool, but just gives us some thinking about, hey, what should we expect going forward?
So we talked about, again, kind of the good and the bad, our expected long-term returns being lower. We wanted to take a slight digression and talk about why of what's happening. Why is it that we're seeing slower GDP growth? Why is it that interest rates really haven't been able to get above a pretty low rate? So what's going on? And we really think that this is a global phenomenon, and a lot of it has to do with global debt. One theory that we think is pretty interesting is that the level of global debt, especially in relationship to its GDP, has really had the effect of restraining growth. It's also lowered inflation expectations, which has led to lower productivity and interest rates. So what are we talking about when we talk about global debt and the size of global debt? Well, what you can see here is back in 1999, global debt was roughly about $100 trillion. And going to, as of the end of 2019, global debt had increased like more than 2.5 times to $250 trillion. We talked earlier and said the consumer actually is pretty good. So the global debt's not held at the consumer level. The significant amount of the global debt is really held at the government level. It's government debt that's being held. And really that the marginal utility of that, of government spending has effectively been dropping as evidenced by lower GDP growth. So 10-year rates are low. We think that if we look at it over time since the mid-1980s or early 1980s, that growth has dropped considerably. And we believe that part of that growth, especially since 2009, that growth in interest rates is a function of that global debt level. So why have interest rates dropped? And we're suggesting that, again, there's a relationship between that global debt and interest rates, which is a lot different than kind of traditional Keynesian economics. But what we're saying is that the rules seem to change when global debt is at such a high level relative to GDP. And again, another data point that seems to confirm that theory is even looking at the recovery since 2009. That recovery has been one of the lowest recoveries in history. Generally speaking, after recession, you see GDP really bouncing back to more than 4%. That didn't really happen. In fact, we saw GDP was positive, but much closer to a 2% level, and has been really consistent. Again, what could that mean? On a positive side, it could mean that our economic cycles are extended, that we have a longer period of economic growth. And that could be positive. But on the negative side, it means that that rate of growth, we certainly haven't seen anything similar to what we've seen prior to 2009. The bottom line is that we think going into 2020, while we are positive, we do see some issues out there or concerns, and we need to be comfortable with the uncomfortable. A lot of times in client meetings, we talk about the certainty of uncertainty, and now we're talking about being comfortable with the uncomfortable.
So one of the things that everybody's uncomfortable about is market corrections. Nobody likes those, right? But they're something we should expect. It's part of the process. So we need to get comfortable with them. And this chart sort of helps, I think, with that notion. So we should expect that we'd see a 5% drop about 3 times a year. Pretty common, and that recovery is pretty quick, within a month or so. Now we'd expect to see a 10% what we call a correction about once a year. Again, pretty common. We expect that to happen. Recovery is pretty quick there too, just over a quarter or so. Now, a bigger drop we'd expect less often, 15% once every 3.5 years, and a 20% drop, or what we'd call a bear market, about every 6 years or so. That takes a little over a year to recover from. Now, this is history, and these, again, are averages. So there's some deviation or risk around what these numbers mean. So 3 times a year could be 4, could be 5 or 6, could be 2. So think about it as just a general idea, but we need to be comfortable that this is part of investing and that we need to be comfortable with the uncomfortable here.
So what should you do based on this information? The first thing we think is, we think you should review your investment time horizon with your advisor. Make sure your asset allocation is appropriate for your specific investment horizon, and certainly for your risk tolerance and risk capacity. Mark, one of the questions that I've gotten from advisors is, well, why should I even be in bonds? Why should I have that as part of my portfolio allocation? And why is there a relationship between that and investment time horizon or diversification when 2018 bonds went up and the stock market went up, and 2018 bonds went down and the stock market went down, and 2019 bonds went up and the stock market went up. So they seem to be positively correlated. So why even have bonds?
Great question. You've picked an interesting time period, and it's very sensitive to start and end dates. So stocks and bonds over time can be correlated, like you mentioned, but they don't correlate in the same time frames. And in fact, since about 1990, 1995 or so, stocks and bonds have generally been negatively correlated over time, although modestly so, not perfect inverse correlation by any means, but about 0.5 or 0.6 negative correlation to long-term treasuries in particular, where prior to that period, they were actually positively correlated. So if you look back at some of the big downturns, like 2008, for example, when stocks were down 40, 50%, long-term treasuries were up 40%, up 40%. So huge buffer to portfolios during times that stocks are down a lot. In fact, if you look just back to last year, at the end of 2018, for example, again, you had stocks down over 20% and bonds up significantly at that same period of time. So your question is, over certain periods of time, there may be some level of correlation, but it certainly protects in significant drawdowns, adds to that diversification, and a smoother ride for the portfolio. So we do think it's still a critical piece of portfolio construction. We wouldn't change that going forward. So what's the second thing we should talk to your advisor about? Block out the short-term noise that may cause you to deviate from your long-term strategy. We talked a little bit about turning off the news, if possible, with talking heads on CNBC and CNN. But that's actually something we feel strongly about, that the noise can cause a lot of concern that's unnecessary, and that it will be there kind of all the time. There's something to talk about, and that's what they get paid for. So try to limit the amount of noise and try to not let that have you deviate from your long-term strategy.
We say keep in mind some of it, there's an entertainment value to some of that financial news that's out there. And so keep that in mind as if you feel like you can't help yourself but have to watch some of that. As we talked about earlier, stocks and bonds, really understand the value of diversification and the importance of rebalancing. When we're talking about diversification, we're talking about stocks and bonds, we're talking about U.S. and international and emerging, international developed. All of those pieces we think is part of a diversified portfolio. Not everything is going to do well at the same time. Unfortunately, a part of diversification is having to say you're sorry for something that won't do well, but it really helps protect the portfolio against fragility. So we are in a period of greater uncertainty, and we really think diversification is an important part of that.
Finally, be sure to have an emergency reserve for savers, or at least a year of cash for those that are withdrawing from their portfolio. Emergency reserve just allows you to have cash available so that you don't have to sell if the markets are down. Same thing for people that are withdrawing from their portfolio. You want to have that cash set aside. So if markets are weak, you're not required to sell and lock in losses when things are down. And we think, again, very important piece of the overall picture.
So with that, we'd like to thank you for participating in today's presentation. We hope that you were able to learn something about both our perspectives on the stock market and the economy, as well as be able to apply that into your own personal investment policy.
If you have questions, feel free to call or email us, and we'd be happy to try to answer those as well.
Thank you.